the Business Finance Podcast, brought to you by the Best Finance Group. New episodes every Friday. Hello, well, it's going to be a challenging 2025. We've got rising inflation, tax increases, high utility costs, and this all means that business owners will have to find new ways of protecting their profit margins. However, with UK insolvencies at an all-time, well, a 12-year high, should protecting your revenue be a key thing to consider for next year? So we're going to talk today about bad debt protection. This is episode 11 of the Business Finance Podcast. He's Jack Seymour.
He's Phil Murphy.
Thank you for joining us. So Jack, bad debt protection today.
Yeah,
something that we talk a lot to our clients about. A lot of companies, their biggest asset is their book debt.
Okay.
On average, accounts receivables represent 40% of a company's total assets. So this is why it's more important than ever to look at your revenue, not just profit, and keep that protected. So UK insolvencies are climbing to a 12-year high, with over 29,000 businesses expected to fail before the end of 2024.
That's not good, is it?
Not good at all. Some analysts are saying anything over 20,000 businesses going into insolvency is classed as a recession for some of these policy providers.
Okay.
We're already at 25,000 insolvencies this year with a few weeks to go.
Well, yeah, I think it has been a really tough year for many business owners out there throughout 2024, and things that are out of their control, external factors, inflation, and recruitment has been a real challenge. There's some industries, especially such as hospitality, which just continue to get battered. You've got to stay in the fight and keep going, haven't you? Yeah,
well, actually, that's funny you mention hospitality. So the construction, retail and hospitality sectors are amongst the hardest hit, accounting for 18%, 15% and 14% of total insolvencies respectively. Businesses across all industries have faced disruptions over the last few years, from Brexit to COVID, to rising interest rates and inflation, as you say. Insolvencies are forecast to decrease by 6% in 2025, but they still remain 30% above pre-pandemic levels. So this means companies must stay vigilant, right?
Yeah, you have to stay on your toes, don't you? Because as you mentioned there, construction is always a high risk, but there are the rewards. And actually, a positive view on it is if there's insolvencies arising, that means that your competition are weakening, and there should be greater opportunities because there's less people in the fight.
Yeah.
So what does that mean? Looking forward to 2025, everyone is saying, and all the experts of the world out there are saying, business growth should be very strong. But it's ensuring that you do have the setup to protect yourself against these bad debts.
Yeah, absolutely. Yeah, well, some people do see risk in the current market, but others will turn that risk into an opportunity. So if you're protected from non-payment, you can extend credit to new customers, enter new markets, and you can pursue growth. But this is why, again, we're talking about bad debt protection today and why it's so important. Looking at some of the big names this year, or some well-known names that have gone into either administration or liquidation. We've got Homebase, Ted Baker, The Body Shop, TGI Fridays, Carpetright, and Typhoo Teas, which has just been rescued.
Yeah.
They went to administration.
And those are such household big names, as you say. And how many times do we hear, I don't need bad debt protection. I know my customers. I deal with big customers. You just can never tell, because no one's going to turn around to you and say, we're struggling, or we're not paying this invoice because actually we don't have the capital to hit it ourselves. They always say, I'll get it to you. It's going to be absolutely fine. And the worst thing is, and we see it time and time again, many business owners out of good faith continue to give them credit. So just trading up to those credit limits and setting credit limits are absolutely paramount. So you're not over trading with those customers, and you've got that bad debt protection, which we'll come on to in a second, no doubt, of how that actually works, how that covers you.
If you've got bad debt protection, if you've got that cover in place, you can often increase the amount. Maybe you'd only normally do, say, £100,000 with a customer, but if you've got £150,000 cover, then there's an opportunity to grow and do more business.
That's a great point. That's such a valuable point that, you will set your internal credit limits through using credit reference agencies such as Experian, Red Flag, so on and so forth. But if you do have bad debt protection in place, you can quite often go above those credit limits that the credit reference agencies have supplied. So it allows you to do more work for those individuals, increasing your turnover, but most importantly, protecting yourself and your own business. So it's invaluable.
Yeah, and if you've got one of these policies in place, they will have alerts and they'll have different markers that will say, oh, this customer, we're starting to see some potential issues with this customer, and they're working with you and keeping you fully updated in real time. So that's really interesting. You did just touch on construction there, so I'm just going to mention again ISG, which was a big name that went through this year, one of the largest construction companies in the UK. Now, administrators expect to recoup just 35 million of a total of 1.1 billion pounds of debt owed. But the trade creditors, the people who did the work for ISG, they're set to lose a total of 308 million pounds. So 308 million pounds worth of hard work that was done for nothing, no payment at all, which is a shock.
I mean, that's devastating, isn't it? Because it's always a smaller construction business. Anyone turning over below 5 million, which we see time and time again, that gets hit because they can't absorb those bad debts. If someone doesn't pay them, then that comes straight off their bottom line. Yeah,
I think it was 4,000 construction companies have gone into insolvency up to September 2024.
Right.
So, a lot of those would have been affected by ISG. So
not good.
So we're going to talk about, I think you've done some bad debt protection quite recently. Is that one you can talk to us about?
Yeah, I could give you an example. Yeah, so it was a client, a transport client, which used invoice discounting. Yeah. They had a facility with a provider, and they were on a bundled fee. Okay, they were turning over about £1.3 million. They're on a bundled fee of 4%, and that included bad debt protection, which is super, super high. So actually, we said to them, well, we'll look at your invoice discounting facility, but also we'll look at bad debt protection, because the chances are that you're overpaying already, having it built into the facility. And when you've got your own standalone facility, you've got control and you can administer, you can set your own credit limits, as we spoke about a second ago, and that allows them to trade up to the relevant levels, as well as check before they take on the contract what that credit limit is on that customer. So we saved them just over £20,000 on their invoice discounting facility, but coming on to their bad debt protection, we saved just the same again on actually having their own policy. It cost them £4,500 for the whole year to get full cover, not just their top 5 customers, full cover, right, as their own policy as well. So that was a true success story, that it doesn't always have to be a standalone. No. But I've got another example as well, just come into the forefront of my mind. It's a sports company which sells sports equipment, and they're selling it all over the world. And they're saying, we're doing a lot of work in America, and some of their customers are slow paying. We can handle that, we can absorb that. We don't need invoice finance, but we just want to make sure that we've got cover on it. So that's what we've done. So we've excluded some of their customer base from their credit insurance, but we've insured and protected against those bad debts on the ones that they want. Yeah, on the big ones. Yeah. That's really interesting. No, some good examples there. Well, I was actually speaking to Sam from PIB Insurance Brokers yesterday. We're having a good chat about this. And we're looking at a quote for a company that's a 6 million turnover business. Right. Now, they're in the food and beverage sector. Yeah. And some of the providers see that as a high-risk sector. Okay. I think they were quoted, to cover that £6 million turnover, they were quoted, the highest one was about £22,000 a year. But the others were quoting around £11,000 to £12,000 a year. So let's say £12,000 to protect £6 million in revenue. It seems like a no-brainer, doesn't it? Really? Absolutely, because no doubt the people watching this check with your accountant, but it could be a business expense or some form of tax deductible expense somewhere along the line that is coming off your corporation tax. So actually, that's going to be reduced further. And for £12,000 to insure £6 million of turnover, it's a no-brainer. When you think about it, even if you lose 1% of your revenue, that's what, £60,000. If you just lose 1% of that revenue, and 1%'s got to go bad, and that's £60,000. So you're all right. So that if you don't take it out and then you lose £60,000, all of a sudden that £12,000 looks cheap, doesn't it? Yeah. And I'll just explain how it works. So if someone has a claim, if it's over £10,000,
typically they pay what they call 10% minimum retention.
Right.
So that's what you would pay. So £10,000 invoice, you'd be paying like £1,000, get £9,000 back.
Brilliant.
Right, under £10,000, it's typically between 500 to 1,500, but typically around about £1,000 again.
Okay.
So that's just so people understand how it works. Well, one important thing, and again Sam was telling me this, it's important. Don't wait until you've had a bad debt to then go and look for bad debt protection.
Yeah.
It's just like your car insurance.
Yeah.
You know, if you're more attractive if you haven't had any claims.
Yes.
And because a lot of the bad debt protection policy providers have had quite a few big hits this year.
Yeah.
They're all fighting over the clean businesses that have had no bad debts.
Yeah.
That look a really, really good risk to try and make some of that profit up before the end of their year.
Right. Okay.
So if you haven't had a bad debt in the last couple of years and you're thinking about this, do it now before you get one, because it will save you a lot of money on your premium.
Yeah.
So I think that's worth
That's
mentioning.
brilliant. Yeah.
Yeah. So this is for a lot of companies, their biggest asset is their debt book. So it's really, really important to protect it. And a lot of serious business owners won't trade without this bad debt protection policy.
I see it as, you know, when you go into a business, you get your professional indemnity insurance, you get all your other insurances, which you have to have and are expected to have to start trading. But bad debt protection should be one of them, because ultimately you're putting money out the door, you're doing work for someone with the best intentions, and you need to make sure that book debt, that invoicing is covered.
Yeah. As I say, people are looking they'll be looking now at protecting how can we protect our profit margins? Are we going to have to reduce costs? Are we going to have to try and go and find more business? But until that, my wife always says to me, until that money's in the bank,
doesn't mean
anything. So
Very
it's
true.
really, really important this next 12 months to keep that in mind and think ahead. So that's that. That's pretty much covered that.
Yeah.
So we're going to go to our newish segment, the Deal of the Week.
Deal of the week.
Yeah, and it's your turn this week.
Okay.
So I've had the last 2 weeks, so we're going over to you. And you've got one hot off the press, I believe.
Yeah, as of this morning. Yeah, so it's a welding company based in the Midlands. They are in the process of selling, or soon to be sold. And is a business which turns over just shy of £1 million. And quite commonly, these businesses are quite difficult because of the lenders out there. So we managed to secure an acquisition loan on an unsecured basis over a 6-year term at 9% per annum.
Wow.
Right.
Wow.
And also it's on a debenture only offering.
Right.
So there's no personal guarantees either.
Fantastic. Yeah.
Coupled with that as well, the buyer will obviously have liabilities for the loan, but they can pay it off free of charge at any point.
Superb.
So I would say that is the deal of the week.
That is a fantastic deal of the week. Yeah, it's wherever we can, we try and offer the a debenture as security rather than a personal guarantee.
Yeah.
Because no one really likes signing personal guarantees. It's a necessary evil at some point.
Yeah.
But yeah, so it's great that you managed to do it via a debenture. Yeah,
absolutely.
I bet your client was very, very happy with that.
Very pleased.
Well done. That's the deal of the week. So well done, Jack. And I think that's it for this episode. I hope that's been of interest. And if you want to have a chat with us about bad debt protection, it's something that we do a lot of, and we'd be happy to run through it with you. And I think that just leaves us to say thank you for joining us. Thank you, Jack.
Thank you, Phil.
See you on the next one. Thank you for joining us. If you have any commercial finance requirements, please contact us at thebestgroup.co.uk.